Howdy there, folks. Welcome into today's video on the reaction channel. Two for me to react to in this one. First one up here, talking a little bit about the market, talking about where stocks are maybe undervalued or overvalued in this market. Adam Peter Parker, going to listen to what he has to say in regards to this one. Then I want to go ahead and react to this one here. Once again, a little market talk here on kind of where things are heading. I want to share my perspectives and opinions on that one here today. By the way, main channel probably tonight or way later today, I'm going to make a video on top 10 stocks on sale. So be on the lookout for that video, likely coming tonight or so. Looking forward to getting into that one. I know a lot of people think there's no deals in this market. There's a lot of deals all over the place when it comes to this market. You just got to know where to look. So I'll be going through some of those on the main channel later today. So appreciate everybody joining me as always. Thanks so much for being here, folks. Thank you for being subscribed to the channel. If you're looking to apply to join my private group, then check out the pinned comment down there. You can fill out an application. We see if you're a good fit to join us in there. Alrighty, guys, let's get into this.
And CEO Adam Parker is with us here at Post 9 to kick this around. It's great to see you, Adam.
Yeah, thanks for having me.
As far as August goes, would we be lucky to get away with a 2% loss for the month?
I mean, you know, obviously earlier in the month we had a pretty big pullback, but last week we got two data points. To me, everything's about perceptions of growth and perceptions of rates. And I was surprised early last week. I think Leisman or somebody said, "Oh, we're in the good news is bad camp," and now we're 9 days later, we're talking about bad news is good, right? So that's the other side of the quadrant with the economic data. I mean, to me, the growth rate looks okay. I think earnings are going to be slightly higher next year than this year, but not as much as the consensus view. And I'm surprised that what's in the prices for cuts by January 25. And every equity investor I talk to all day long, none of them think that they're going to cut that many times. So we'll see if this is perceived as dovish, obviously on a one-day view or two-day view. We'll see if that maintains itself.
Has your view on earnings changed?
In terms of rates, this is where we're in a sticky spot. Very, very sticky spot. Because a lot of people are looking forward to the day the Fed starts cutting rates, right? But here's where things get sticky. If the Fed usually is cutting rates, it's usually because economic data is getting very bad and they need to cut rates. They feel like they have to cut rates to try to save the economy from devastation that's coming, right? So from that standpoint, that's a little scary. It's not as exciting as it might seem. And this is why many times, while the Fed's cutting rates, you actually see the stock market going down during a time period when they're cutting rates, because people realize, oh man, the economy's bad. So that's where you get in this weird scenario of like, yeah, we would love rates lower, but are they going to be lower rates because the economy's getting hit bad at that particular
Adam,
time?
I do remember conversations at this desk where you continued to talk about the fact that we might actually see lower numbers. I think it was 24 or 23.
Yeah, kind of flat. Maybe not so much. Yeah, we haven't changed our numbers at all this year. We're at 215. We've been there all year, and we're at 225 next year. We've been there all year. And what we said on the program was maybe 24 won't be very much above 23. We'll see. I don't believe this V-shaped recovery thing, though. That seems really unlikely because you had really high nominal GDP last year. Factories were running very hot. And you had huge pricing power. And I think now our view, we wrote a big note on industrials yesterday. Our view is like, I don't want to say we're the whole pig's through the python from COVID, but it's getting mostly through, and we can kind of have more of a normal cycle with demand-supply dynamics going forward. So I think we're going to have eroding earnings expectations and slightly higher earnings next year than this year. I think that's a good base case.
People worry about September, the cruelest month. Then others come back and say when your year-to-date gain is this big, it's actually not as bad on a seasonal basis. How do you think about that?
Astrological a little bit, I mean, you need a lot of data. I was joking around with Josh Brown about this on the air a couple weeks ago because he had this sort of third year of the election cycle thing going.
Yes.
And I'm like, come on, man. I'm going to need like 100 years of data to have statistical significance on that. So I worry that stuff's a little spurious. I've seen those same things too. I think it's all about the market leads year-over-year growth by 2 to 3 quarters. We're going to have accelerating growth through Q2 of next year. It's a fait accompli. And then it looks kind of choppier in terms of whether it accelerates or decelerates in the second half of next year. So all we're trying to figure out is, will their earnings grow at an accelerated rate year-over-year in the second half or not? And I think it's tough to call right now. So I think the market stays a little bit more range-bound. I think every person has a challenge justifying the valuation, right? Because you just don't, let's say you're coming today, you're bullish, you think the S&P is going to 5,000, right? 10% upside, round numbers. you got to pay 20 times the consensus numbers at the end of this year for next year, 22 times my numbers. The market never stays above 20 times sustainably. So that's only likely if the numbers are too low, which I don't think is, or we're just at the beginning of a multi-year earnings cycle again, and it's like 2012 where it grows all the way to 19, and maybe that's where we are. That's what we need to believe, I think. In order
to justify that?
Yeah.
Yeah, I think you got to understand the time period we're in and coming off of for kind of the future years, right? If you think about this time period for corporate earnings, it's been horrible. It's almost like companies have had to go through a massive recession, right? Even though technically we never had anything defined as a true recession, right? Look at company earnings and tell me these companies haven't basically been through what you would assume is a big recession, right? Apple can't grow revenues. What? AMD's revenues down 18%. Companies like Meta and Amazon had trouble putting up any sort of growth. Tesla cutting price. You look at what these companies have gone through over this past year or so. And if you look at corporate earnings, it would basically tell you it's recession, right? So the thought process, you come out of that and you see corporate earnings increasing over the next few years, as long as you don't get some sort of new leg lower in terms of like a finally called recession on a high unemployment or something like that, right? So that's where you got to look at all sides of this. And this is where I think we're in one of the most intriguing times I've certainly seen the market in my 15 years of being in this market, because there's so many different scenarios to play out here. I don't think you can be a full bull, as in 100% convinced like we're only going up for the next year. And I don't think you can be full bear right now. I think both are delusional. To be quite frank, if you think all stocks are skyrocketing over the next year, or you think all stocks are going to crash over this next year, I think both sides are delusional. There's too many possibilities in this scenario to be so sure that one side or the other is going to play out here. I think that's just kind of more of like a gambling thought process of thinking you can for sure like this is going to happen. There's a lot of different scenarios to play out here, folks. And when you got earnings that are basically coming off of a recession, it's pretty intriguing.
The 5,000.
You were pretty early talking about the prospect of AI.
Yeah.
Even in the workplace and overall in terms of what it would mean for the market. Carl and I were just talking about NVIDIA, the reception to the earnings. I'm just curious.
And by the way, if we're going to be on a 2, 3, 4, 5, 6 year earnings cycle for stocks where earnings go up and increase and things get a lot better, then stocks are actually extremely undervalued right now. The only way they're really overvalued is if let's call it earnings deteriorated again at the end of 24 or into 25 or something like that. And that's a situation you say stocks are actually overvalued right now.
Your take overall, Adam, specifically to some of the names that are obviously garnering significant revenue increases from AI and those perhaps that are hoped to but haven't yet.
I mean, look, what we all want to do is tag every stock. Are you a beneficiary? Are you impregnable? Are you disrupted by it? And I guess increasingly, are you fake? Are you fake AI? Like we track every word related to AI in every transcript over time. And there's lots of companies that are using AI-related terminology that have nothing to do with AI. So I think a lot of management teams, IR guys have figured out, let's sprinkle a little AI dust into our transcript and see if we get a little multiple expansion. So I think part of what we're trying to figure out is like who benefits and who doesn't. And you in the setup of the show, you nailed it. I mean, NVIDIA had the biggest upward sales revisions of any mega cap company ever 2 quarters in a row. And I do think it looks cheap. It's the fastest growing mega cap company. And, I don't know. It's all like a perspective.
Before we go further here, you're not going to know, if you want to know who the real AI companies are and who the fake AI companies are that are just using AI as like a buzzword, right? You will absolutely know the answer to that in 2024. If you've listened to these companies' conference calls, if you've kind of tracked the whole industry, 2024 is a year where a lot of these companies on the software side are supposed to start generating significant revenues from AI, right? We really haven't seen these companies generate anything yet. It's really, 2023 is really the hardware year. 2024 should be a hardware year as well for AMD, NVIDIA, some of these guys. But in terms of, it's all about setting up the infrastructure. And so if you're thinking about when do these companies actually start generating, the ones that are talked about as, benefiting in a major way, it's really 2024. That's when we should start seeing it hit some of these companies' numbers in a positive manner. And I'm even seeing some companies, even Loom recently just launched an AI product. And It's like $4 a month. They just launched it right now, right? I'm sure that's not going to be a huge beneficiary to that particular company. They're not a public company, but I'm sure it won't be a huge beneficiary to them this year, but I'm sure it will be next year and going into future years, right? That extra $4 a month, for that service that they could probably go up to $6, $8, $10 long term. So yeah.
I think 6 months ago when it was 700 billion cap, we wouldn't be surprised if it was 2 trillion in 5 years. I don't know. I didn't think it would happen, this quickly, but
Right.
maybe it's 2 years. I don't know.
Right.
I'm not saying it's a smooth sailing, but and as a former semiconductor analyst, you can certainly, I've seen, you get burned and think things are structural and they're cyclical at the wrong time. I've made that mistake many times. So, but it seems to me like they're the easiest beneficiary. But I think there's other silicon companies that will benefit: AMD, Marvell, others. And I think what the market told you earlier in the month was, I'm going to sell the good news, and I don't believe it. And now I think there's a total change to all cyclicals in investing. If people think things are good years 3 through 10, they almost don't care if fundamentals slow. Housing, it's the same thing. We know we're short structures, so yeah, I want to, but other things where they don't believe the 3 to 10 year story, airlines, I'm going to sell them. The airlines put up great numbers, but everyone's like, they're cyclical and they're not good businesses years 3 through 10, so forget them. Whereas I think anything silicon related, compute related, or housing related, I think people still believe we need more in years 3 through 10, so they'll overlook the next 6 months and just believe the dream long term.
Yeah, nothing really to add there. They're kind of the finish from Adam Peter Parker, but appreciate his thoughts there. He's always pretty fairly balanced. All right, let's get into this one now.
Low. The S&P 500 was down 5.5%. We're only down 1.5% now. So we've kind of scratching and clawing our way back.
We talked about the other day, the most important data point is what's going on with bonds, what's going on with the 2-year and what's going on with the 10-year.
Right.
And what drives bonds? Economic data. And the economic data, unlike what the Atlanta Fed is saying is going to happen later on in the year at 6%, which now we know that's not going to happen, continues to get softer and softer. And so this is good news for the economy right now, as long as we can continue to glide down and then flatten out.
Soft news is good news, right? Yields, to your point, the 2-year lowest level since August 11th. The 10 years back, we just showed it, 410, bottom of your screen. Wasn't that long ago, Joe.
Yeah, and if you're wondering what rate matters the most to the stock market right now, if you're like, I'm sure you hear, what's affecting the stock market? It's all about rates right now. If you're wondering what rates specific as far as time frame matters the most, is 10-year right now, 30-year, and then the 2-year. Those are the ones that matter the most, but it's actually the 10 matters more than anything right now in the short term for this market. So just some food for thought if you want to keep the 10-year as, at the end of the day, the market's been pretty simple recently. 10 goes up big, market goes down big. 10 goes down big, market goes up big. It's been a pretty dang simple scenario here recently.
Talking about, north of 430 on the 10-year. Market, yields start to run. Market gets nervous. As we said, S&P was down 5.5%. The NASDAQ was down 8.2% at its August low. It's only down 2.2% now. So everything's kind of rallied back, whether it's small caps, Dow, NASDAQ, S&P.
Yeah, first of all, what I like about today's price action is that we really did not go back deeply into yesterday's trading range. So that creates a degree of validity in the move higher. Basically, we pierced into the range yesterday, and we've maintained that and bounced from there. It is, to Bryn's point, it's all about yields. It's all about the fact since Monday, a 2-year was 5.10. Now you've got a 2-year at 4.86. What has that done to expectations for what the Federal Reserve is going to do? As we sat here on Monday, there was a 75% probability of another 25 basis point rate hike from the Federal Reserve at some point this year. As we sit here today, that is now down to less than 50% probability for another 25 basis point
Let's see
rate
what
hike.
PCE does tomorrow, right? We can't get too far ahead of ourselves because we need that report to come in a way that investors view it as favorable for what the Fed's going to do, and also one that doesn't start pushing yields back up.
Without question, you should not look at the price action in the last 3 days and say, okay, case closed. We understand the Federal Reserve now kind of sits back and waits, and we feel as though all the data has gone in the way of the bulls. No way. The price action, though, since Monday should be encouraging. Why? Because what it is suggesting is that the deeper correction thesis that was so dominant in the middle of August,
pervasive in the middle of the month, right?
Right. And this is more consistent with a more normalized 5% at its step type of correction.
Jerry, bottom line is this is exactly what the Fed and investors want.
Yeah, that's 100%. And I've been talking about this, I'm sure, on this channel and certainly on the main channel recently, right? Where when you're in a normal market, I know, some of you guys watching this video have been in the market 5, 10, 15, 20 years. And some of you guys, might be your first few years of being in the market and paying attention to all this stuff, right? In a normal market, I can tell you, you have 5 to 10% pullbacks all the freaking time in the NASDAQ and the S&P 500, but certainly the NASDAQ. It is very normal. So sometimes you'll have multiple times in a year where maybe first half of the year you have 5-10% pullback in the NASDAQ, and later on in the year you have a 5-10% pullback on the NASDAQ at some point in time. Okay, and even if you have one of those pullbacks, let's say in a year, you can still actually have the market very green. I've seen it before where the NASDAQ has one of those 5 to 10% pullbacks at some point during the year and still finishes nicely green. There's a lot of examples I could go through over time where that happens. So just understand the pullbacks, the corrections, whatever you want to call them. This is normal market, man. Normal market. If you talk about 20% type moves for the NASDAQ, that's a whole different ball game. Okay, those moves you might only get every few years, but a 5, 7, 8% move, that's nothing, man. That's normal activity. Those are usually just huge buy the dip opportunities for folks that maybe are a little underinvested at that particular time. And sometimes they're just time periods when a lot of people, are looking to maybe cash up a little bit or looking to put money other places.
Slash need, right? You need growth to still remain nice, reasonable, not too crazy, not too hot.
Right,
Today you get, the picture from ADP and some other economic data which suggests, okay, it's cooling a bit,
right,
which is exactly what the doctor
ordered.
J. Powell ordered.
It's better than expected. And last week, I remember.
All right, so here we're looking at S&P 500 earnings, right? Certainly down over the past several quarters. When you see something like that, it's basically recession. You know what I mean? I know we haven't had an official recession and those sorts of things, but this right here, that's recession. Like, company earnings usually don't fall several quarters unless it's a recession. Like, that's just something to kind of keep in mind. And the belief is that earnings are going to kind of pick up and get better and better, and the growth is going to get better and better. I think it really depends on the companies. I think, companies like Meta are going to fit that criteria. I think companies like Amazon are going to fit that criteria in a major way. I think companies like Nvidia are going to be there in a major way, but obviously the numbers are going to crush these. So there's a lot of stocks. Mr. Softy's always going to put up their numbers. Google, McDougal's always going to put up their numbers. So there's a lot of stocks that, for sure, that are stocks that matter in a significant way, but we'll see their earnings pick up quite a bit next year. I even know a lot of small cap stocks that I expect actually their earnings to pick up quite a bit next year versus what they reported this year. Foot Locker comes to example. That stock's being killed. I expect all their earnings to all be the lowest in 2023, and everything's going to pick up substantially for them in 2024, even if their revenues aren't going to pick up just because there's got a bunch of restructuring costs. And a lot of these companies are doing all this restructuring right now, all these one-time costs, stuff like that, and it all hurts earnings in the short term.
Talking about how a decline of 3 to 5% was healthy, and we talked about what is healthy. I mean, everybody says it's healthy until they start to feel sick to their stomach.
Yeah, right.
Yeah. So far, I feel that this has been more healthy than sickening. And Jay Powell scared some people in his tone the other day, but it really made other investors feel comfortable. I think for us, it was comfortable, and the PCE number continues to come down. I think there's no question that he's on the track that he believed he would be able to maintain. We don't have a recession. We haven't had a recession. And 3.5% unemployment is not a case where you're generally going to have a recession pop up and crush earnings. Earnings growth, I think, becomes the thing people have to worry about and care about.
Let's also put in perspective, too, this idea that, the fall is historically bad, September, October, historically bad for stocks. Yes, that's true. But the caveat being that when August, or when you make it from the beginning of the year through August the way we have, not so much for a bad September, which is one of the reasons why Tom...
You know what I wouldn't be surprised of? Everybody's, keeps talking about, September bad, October bad. Remember what happened going into this year. Everybody and their grandma was talking about how the first half of the year is going to be so bad. that baby was anything but bad. It was phenomenal. So everybody's talking about, oh, September, October bad, and usually the thought process is November, December, Santa Claus rally, right? Don't be surprised at all if September, October end up actually being good, now that everybody and their grandma's talking about, oh, September, October, you need to be so scared, blah, blah, blah. And then don't be surprised if November and December somehow end up being bad and catches everybody off guard, and they're like, where's the Santa Claus rally? Why are we going down? Like, I always think about the market sometimes in terms of these short-term things of like, what's everybody convinced of? And what's the opposite of that? Because it's funny, man. Because what happens is a lot of these people put money wherever they are all convinced something's going to happen, or take money out of something, right? And usually that's when you see bottoms, when everybody thinks everything's going down. And usually that's when you see tops, when everything is, great. Let's just call it that. So I can tell you, if September and October are rolling, there's going to be a lot of people convinced, oh, we're going to roll into November and December. Santa Claus rally, baby. Here we go. And that would be intriguing if then the market dumps.
Suggests you're going to get 2 to 3% gains this month. Morgan Stanley, one of their PMs had a note out, or an interview on Street Signs Asia, CNBC Asia, that the S&P is going to get closer to 5,000 by the end of the year.
With Tom Lee, of course. Like, come on. Tom Lee's going to always think the market's going up. There's going to be no period where basically Tom Lee's not going to be bullish on the market. The market could be at 5,000. He'd be saying it's going to 5,400. That's my man. And Mr. Tom Lee, he's always bullish.
Captured 4,500 today. We're at 4,524.
There should be like some sort of parentheses that like goes along Tom Lee's name or something every time they show him, and it's like Mr. Permabull, okay? But in all seriousness, in terms of one thing I think that could happen in this market that would give a lot more confidence that the rally is sustainable and that we could roll into 2024. The biggest thing I think actually is if we start to see the Russell 2000 get into gear. The Russell 2000 has been a lagger for years. And there's usually when people are more confident about the state of the economy, they feel more comfortable getting in some of those small caps and they see upside there, right? The problem is we haven't seen the Russell roll yet. The Russell's been in a tough place for years. And so if we can finally get the Russell together, then we're really talking in regards to this market. I appreciate everybody joining me as always. Thanks so much for being here, folks. Thank you for being subscribed to the channel. New all-time high subscribers in the history of the channel. If you'd like to apply to join my private stock group, check out the pinned comment down there. And when you join us, say hello to me. Much love and have a great day.